Hello, and welcome to Your Estate Matters, presented by Heritage Trust. Your Estate Matters is a podcast dedicated to everything estates, including building and preserving your legacy. If it's estate-related, we'll be talking about it. We're having the conversations today that will help Canadians protect their families, their assets, and their legacies tomorrow. Jonah, thank you so much for joining us.
Yeah, pleasure. Thanks for having me.
It's great to have all your expertise available for our listeners. So you've spent your career at the intersection of U.S. and Canadian tax law. What drew you to this area, and how did you end up building a practice focused on cross-border planning?
Well, it's an interesting story, maybe too long for the current environment, but the key was that I happened to join a firm that specialized in this as a result of lifestyle choices I was making. But the interest was there because I was born in the U.S. We moved to Canada when I was a toddler. And so as I learned all of the material, it was so relevant to my personal situation that I feel like I really wrapped my arms around it and can relate to clients who are in a similar situation.
And have you kept your citizenship?
Oh, yeah.
Okay.
Yeah, I've spoken with so many about renunciation, and I think I'm on the same page as most. That's interesting to know about, but there's something about it that I'm happy to keep it.
Mm-hmm. I've seen both sides of the lane, people renouncing and people keeping it. And I mentioned to you, I have 3 children who are dual citizens as well. So I think...
Right. It's not as bad as all that.
You don't think so?
No.
Yeah.
Totally manageable.
So speaking of that, you co-authored a book called Americans Living in Canada, Smile, the IRS is Watching You. That title alone tells a story. What was your impetus for writing it, and what were you seeing in your practice at the time?
Well, this was a book that I wrote during the initial stages in the late 2000s, when the U.S. was really becoming a lot more interested in compliance for, citizens who were living elsewhere. And this is when the FBAR sort of awareness really began, even though it had been on the books for decades. And so I felt like there was a lot of need out there for increased awareness and getting people sort of back on track before the hammer came down on them.
So not everybody's going to know what an FBAR is.
Right. So the foreign bank account reports, this is not actually an income tax rule in the U.S. It's under much more of an anti-money laundering type of legislative regime, but it does require U.S. citizens to annually disclose foreign bank accounts that they have signing authority over. And so this is, like I say, it wasn't a new thing, but it certainly became I think, identified as a revenue source for the IRS at that time. And ever since, it's become, increasingly important to keep up with those obligations.
And so if you're a U.S. citizen, is that, even if you live here, is that something you have to do every year?
Absolutely.
Okay.
Absolutely. If your aggregate balances are over $10,000 in any given year, you need to report those accounts.
So when dual citizens or U.S. persons living in Canada come to you, what are the most common misconceptions they have about their tax and estate planning obligations?
Well, I'd say the most common is a misunderstanding of the continuing obligations that they have in the U.S. It's a unique country in the world that requires annual tax compliance regardless of where you live. And so just because you moved away and don't have any assets or income coming out of the U.S. does not mean you're off the hook from an income tax reporting side of things. And, the on estate planning, there's so many rules. Not only in Canada, there's a lot of rules, but there's a whole different host of rules on the U.S. side. And marrying those together into a comprehensible plan that achieves your objectives is, it's really important and not obvious at all.
So let's set the foundation for our listeners. The U.S., as you say, is one of the only countries in the world that taxes its citizens on worldwide income, irrespective of where they live. So what does that mean in practical terms for a U.S. citizen who's been living in Canada even for many, many years?
Well, it means, first and foremost, a second accounting bill every year. Maintaining compliance is often little more than hiring a separate CPA or a different CPA that has a capability of filing in both countries. The vast majority of Canadian resident Americans don't have any U.S. tax to pay because we have a mechanism of treaty credits and also just within the domestic law that prevents, if you're living and working in Canada, you'll pay Canadian tax. It's a higher rate of tax than the U.S. imposes, so there's no tax to pay. There's a few loopholes that I'm sure we'll get to in the course of the conversation, or pitfalls that need to be aware of. But for the most part, it's just an extra tax return.
So at death, both countries impose a form of tax. So in Canada, we have the deemed disposition, which triggers capital gains tax. The U.S. has gift and estate tax. So how do those regimes interact, and where do conflicts arise?
Right. So it's a really important topic. Oftentimes we say Canada doesn't have an estate tax, but that's not quite true because there's a deemed disposition of all assets and the capital gains tax that may be realized there is payable in the final year. On the U.S. side, it's a completely different regime, totally divorced from income taxes based on the fair market value with a very healthy exemption. So sometimes it becomes a matter of focusing on which is going to give rise to actual dollars to pay in the estate and focusing your planning efforts there. The treaty does a really good job of avoiding double tax. It's not perfect. I think the area where you have the biggest jeopardy is in relation to gifts, because the treaty has no system of crediting out Canadian tax versus U.S. gift tax and the other way around. And you can end up with all kinds of double tax problems. And so, for example, clients often come to me and say, well, should I just add my kids to title to their house? And I thought, that's the worst idea. That of all of the things we could do, simply giving your assets away is not the good one. Mm-hmm. There's many other plans that are much more tax efficient, even though it sounds like the simplest.
So is it correct that the exemption is 15 million U.S. currently?
Right. So every U.S. citizen has an aggregate lifetime exemption amount that covers both gifts and estates. Mm-hmm. Currently, it's around 15 million, indexed to inflation. So it ticks up a little bit every year. That, for the vast majority of people, takes care of all of those problems. And all we really need to do is make sure that we're not stepping in any traps. Now, on the Canadian side, we're much more focused on capital gains. Mm-hmm. So dying is a capital gain tax event, making a gift is a capital gain tax event, moving away from Canada is a capital gains event. Mm-hmm. So we have to be managing the cost basis. And if you're paying tax in one country, you want to make sure you're getting credit for it in the other. And that's really the key.
So I've got a question about spouses. So if people are married, do they get a $30 million exemption, or does it work that way? Or
well, it sort of works that way, and it can work that way. But typically what we have in the U.S. is something called portability. So if you are a U.S. person and you don't use all of your exemption, you can port it over to a surviving spouse, which effectively doubles that exemption. It's not always perfect, and it really depends on if your spouse is a U.S. citizen or not, because the rules are completely different. Mm-hmm. But, in Canada, we have a rollover, so there's no tax payable when you die and you leave your assets to a spouse. Under the treaty, we can double up your basic exemption if you're American and your spouse is not. If you're going over that, then we're looking at special U.S. trusts that have all kinds of complexities to them that are really sort of a last resort, in my view.
So question. So in Canada, if you have a legal spouse and you die and those assets are going to your spouse, as you said, they're often capital gains exempt until the last to die. But what about putting your spouse on title if you or they are American? Is that considered a gift? How does that work?
Well, the gifting rules really depend on what we're talking about. So if you add someone to title of real estate, that's considered a present gift for U.S. tax purposes, which, again, there is no unlimited spousal deduction if the recipient spouse is not American. So we have to be careful about that. There's an annual exemption. If you're adding someone to the name on a bank account, then what the U.S. regulations say is that the gift occurs on withdrawal from that account, not on contribution. So it's really important to have a pretty fine understanding of how these rules come into play and act accordingly to make sure you stay on side and achieve what you're trying to achieve.
So what about a lot of Canadians own real estate, maybe in Point Roberts or Palm Springs or Arizona? What does that mean in respect of Canadians that are buying property in the U.S.? Can they just do the gift rules apply? How does that work?
Right. So yeah, that is where this practice started for me, is sort of a snowbird planning practice. And certainly back in the, around 2010, 2009, that sort of time when the dollar was at par and our interest rates were very low, the U.S. was coming out of their housing crisis. Prices were rock bottom. And so it was really a buying frenzy. And there was a lot of planning that had to go into that because people coming from a Canadian perspective just didn't really understand how those rules worked. And so there's a whole sort of universe of planning that's available for those people. The key, I think, is to get the advice before you make the offer, because sometimes it really is important how that offer's structured, whether you want to put some kind of planning in place, whether it's an entity or a trust or just, estate planning type documents. You have to understand those issues and really make that plan before you purchase in a perfect world.
So semi-retired couple buys a golf condo in Palm Springs. What would be standard advice about how they do that?
Well, if it's a strictly personal use place that they want to go use for lifestyle purposes, then really what we're talking about is succession planning and what happens if you either become incapacitated or pass away while you still own that property. A lot of times I'm not the type of lawyer who has a one-size-fits-all for every client. I think it really is important to start with the objectives and the facts and, where we are now and where we're trying to get in the future. In Palm Springs and California especially, I do not like to rely on probate because probating a will in California is not only expensive, time-consuming, it's very challenging. Furthermore, state law limits the amount an attorney can charge for probate fees. So if they think it's not worth it based on the percent of the value that they're going to be able to earn on that file, they just won't take it. And it can be a real challenge. So I always prefer to structure title to not leave it up to probate.
So that would be, if they owned it jointly, that would be on the last to die. It would go into a trust.
Right.
Or...
So if you've got a husband and wife and they take title as joint tenants with a right of survivorship, of course, one spouse passes away, the other can just sell it. They're automatically the owner of that property, which is great. The timing can be challenging on that one. You never know how much time you have in any given period of one's life. So, if I always start with, okay, in a perfect world, if everything goes according to plan, how long are you going to keep the property? And what circumstances might cause you to want to sell it, right? And then is it feasible? Everyone's, no one has a crystal ball, so we have to do our best with what we can. If the answer is we want to use this place till we can no longer use it, we should probably put some structural protection in to prevent that property from going into probate. And
so what are the main structures? Is it a trust? What is it?
There's trust structures for sure. I have put in place many trusts, and there's different types of trusts depending on the different issues that are in play. You can also use entities that don't die when the owner of that entity dies. And so by putting title in, like, for example, a partnership of some kind, the partnership is on title and the ownership of that is governed in BC according to your local documents.
Okay. So let's talk a little bit more about this Canada-U.S. tax treaty. You say it does a lot of things, but it's not perfect. Like, where is it currently falling short for people?
Well, I think, hearkening back to what we talked about earlier, I think the gifts is an area where there's a real shortcoming in the treaty. We have a special, quite unique provision, Article 29B of the treaty provides the, credit for Canadian taxation on death versus U.S. estate tax. No such no such coordination on gifts. So we have to be really careful around doing anything that can either be considered a gift or is actually a gift. So that's one area for sure. I think the other area really where it falls short is there's some entity characterization problems. The classic one is the limited liability company in the U.S. is taxed fundamentally differently in the U.S. versus Canada. And because CRA has, a pretty aggressive view on how LLCs should be taxed, you can run into some serious problems. They don't get treaty benefits because they're not taxed at the entity level. It's a real problem that I deal with monthly in my practice. Some of the newer sort of financial products that are out there just don't get covered. So the RESP type things, the TFSA is not yet fully recognized as a tax deferred entity or type of account. So those sorts of things, I feel like the treaty moves very slowly. They don't update it very often. It's many years between updates. It's hard enough to get tax legislation passed in one country, let alone having two countries agree on new rules.
Right.
And so a lot of the sort of newer tax deferred accounts can be real problematic, notwithstanding an excellent treaty that we rely on for many important things.
So let's talk about the main planning tools. So you've got a dual citizen. Is there anything particular they should do in their will, for example?
Well, I think, a lot of people, the first thing I think that people need to understand is that a large proportion of the estate planning sort of bar in Canada doesn't understand whether there's a problem or not. All they know is if there's Americans involved, I'm not comfortable. Okay, so there's a lot of people who are having trouble finding proper help to, winnow out, is there an issue? Is there not an issue? Right? And just getting any advice at all. I have known very, very competent estate planning counsel here in British Columbia who, in their, standard forms are excluding anyone who's a U.S. person just because, I don't know, it sounds dangerous. It's not always dangerous, right? If you understand how to manipulate those rules, and manipulate, I think, is actually the wrong word. How to just work in that context, then you can find solutions. And to be honest, I would say a majority of U.S. citizens in Canada don't require any special planning in their wills, right? But how are you going to know whether you do or you don't, right? So the facts really drive that complexity, and the complexity drives the sophistication required in those planning documents. So I would say most of the time it's a look at the facts, rule out the major problems, and prepare something that doesn't have any problems with it. Other times, if they're, higher net worth or have more complicated structures or assets, then you do need specific planning that can only really be implemented by someone who understands the issues.
So let's talk about what the big minefields might be then. So just so people know where the danger areas are. So I heard from you significant inter-vivo, so lifetime transfers to adult children can be an issue. Is that correct?
It can definitely be an issue.
And so is the issue the parent as the U.S. person or the child as the U.S. person?
Well, either way, they both represent different types of problems. So if the child is a U.S. person, anytime a U.S. person receives a gift that's over $100,000 in any given year, that must be reported to the IRS, not because it's a taxable receipt, right? But if you don't report it, then they can just absolutely hammer you with penalties. It can be 25% of the value of the gift. And I have had real files where all of those transactions happened before I was involved, and I've had to do IRS appeals saying, look, under these circumstances, this is not a reasonable penalty to impose. And, I've had some success with that, but to get to a level of review within the IRS where someone has the sense and discretion to actually offer relief, it's punishingly time consuming and therefore quite expensive. Now, if the U.S. person is the parent, that's a bit of a different situation because we have this very generous lifetime gift tax allowance. Sometimes all you really need to do is file the gift tax return because they'll never need the whole $15 million. So it really, again, I'm going to sound like a broken record, but everything comes back to the facts.
Right. And what about the primary residence exemption? That's something that U.S. persons don't seem to be aware of. Do you want to talk about that?
Yeah, that's a really good one. So as we know, in Canada, the sale of a primary residence is always fully exempt from tax if you've lived there the whole time you've owned it. That's just, that's become a majority of Canadians' real savings plan is the home that they live in. So what they don't realize, and often this comes up for people who came up from the States a long time ago before there was a lot of awareness of a lot of these issues, the Internal Revenue Code in the U.S. offers $250,000 exempt from capital gains tax, and the rest is taxable. Now, if anyone's lived in Vancouver since the 70s, their gains are a whole lot higher than that. And I've had to break the hard news to clients to say, I'm sorry, you can never sell this home, right? You will own this home until your death, or you will pay, $1 million in U.S. capital gains tax. It can be very punishing. There are sometimes strategies that can be implemented to relieve that. And, if you've got, one U.S. spouse, one Canadian spouse, you can avoid the capital gains tax on the sale. But, for a single person who's owned their home for decades, it can be a real problem.
Yeah. So I've seen clients and beneficiaries that did not know about that. So that's something that I've seen a lot.
Well, it happened to my parents when they sold their home, my childhood home. And it didn't occur to them because I was not yet, into this practice area so deeply. No one asked the question. The CPA never asked the question. It was before we had to designate the principal residence on sale.
Right.
And then as a result of their FBAR filings, all this money was suddenly in their reported bank account. The IRS said, well, where'd that come from? Story came out. And they ended up paying a pretty sizable chunk of tax.
That's unfortunate.
It's very unfortunate.
So let's talk about another minefield about who should be named as executor. So at Heritage Trust, often we are considered because the kids have moved to the U.S. They're either they've got a green card or they've actually become citizens. So what is the real issue if your Canadian parents, the children move to the U.S., become U.S. taxpayers? What is the issue in respect of them potentially being executor of their Canadian parents' estate?
Right. Well, there's a number of different ones that may or may not be important. So there's just the practical aspect. If you don't live here, you're not available to do the work of the executor. It's actual work, as you know. And so, as a practical matter, it is better to have someone local who can, be boots on the ground and do the day-to-day tasks of administering an estate. So that's one thing. Another thing is, of course, if you're a U.S. person and you become executor on a Canadian estate, those are foreign bank accounts that need to be reported on your FBARs. And so sometimes, divulging that information is unpleasant and you don't want to do that. Other times you just don't know, and then you're facing penalties for not having done it. So it depends on a level of education. There are more substantive reasons in certain cases that you need a Canadian executor. So if you're if a non-resident being an executor of a Canadian estate, that estate under Canadian tax law may be considered non-resident. And that closes the door to some really important post-mortem tax planning that, again, not an issue for every estate, but if you've got private corporations or you need to do some, post-mortem transactions that rely on graduated rate estate status, then you simply cannot be the executor if you're not resident in Canada. So those are the kinds of circumstances where I strongly advise my clients to have a trust company we know will be resident in Canada. We know that they know what they're doing and can take over that job. And oftentimes it's a huge relief, honestly, for the family to know that that stuff's taken care of, and it's absolutely worth the cost in certain cases for sure.
So let's talk about trusts. So they're regularly used in estate planning in Canada, but when you add a U.S. element, the rules can change dramatically. So can you talk to us about the main issues in respect of Canadian trusts that may have U.S. beneficiaries, and the other cross-border issues that you see?
Yeah. So, wow, this could be a whole series of podcasts for sure. So there's a lot there. The first thing I think that's worth sort of starting with is the IRS and the U.S. government, the tax law generally has a strong aversion to U.S. persons being involved in foreign entities in any kind of way. So whether it's corporations or trusts or other types of entities, there are punitive tax rules that are intended to dissuade Americans from getting involved and hiding their capital offshore is what the mischief was originally. Now, of course, it's a blunt force instrument, and it's not always, what the motivations of the taxpayers were. So there are tax rules. So if you've got a Canadian trust and one of the discretionary beneficiaries happens to live in the U.S., you can have an accumulating problem the more you keep the money in the trust. And even though you are a discretionary beneficiary in the U.S., so you have no actual right to a distribution, the IRS will sort of assume that you have that right. And if you're not receiving those distributions, you have a nefarious purpose. And so there can be some significant tax penalties for future distributions of income that was earned by the trust in a prior year.
Does it have to be capital? Like a lot of these trusts own shares of private companies, or they're the beneficial owner of real estate. Like what about scenarios like that?
Right. Well, I mean, then if you've got private company shares within that trust, you've got problem on problem in ways that are very complicated to untangle because, as I said, there's a whole different suite of rules for U.S. persons who own interest in foreign corporations. Not only just simple reporting of the facts that have penalties if you don't do it right, but also substantive tax rules that aim to punish later year distributions of previously earned income in that company. And so, it's really important if you have that situation to get the real facts and analysis on how that's to be treated. There are ways to structure those trusts to avoid those problems, at least, currently, until it's time to look at succession. But you can have your hands tied pretty tightly behind your back if you get yourself into a bad structure.
So it's important to get advice up front.
Absolutely.
So what about common estate planning structures like alter ego trusts and joint partner trusts? So just for the listener, since 2000, if a Canadian is 65 or older, you're allowed to set up this trust, which is effectively like a will substitute, and you can put your assets into it without triggering tax, and it's a mechanism to avoid probate fees and have privacy and things like that. It was sort of the sexy thing to advise people to do when they first came out. We don't see them as much anymore because with the complexity of the regulation and the transparency rules and the tax, people are increasingly declining to use them. But people who still have them, if your beneficiaries are potentially U.S. citizens and or taxpayers, is that a problem for those Canadian structures?
Let's see. I mean, I feel like it's not per se a problem. Okay. It's really important if, like, I prepare those sorts of trusts for Canadian only clients who have beneficiaries in the U.S. Okay. And so what you have to avoid is grabbing a cookie cutter template off the shelf and hoping it works in that context, because while this original settlor is alive, there's no problem because the IRS will look right through that trust and pretend the Canadian person is the direct owner, and so therefore it's fine when a U.S. person inherits, as long as there's no continuing trust.
For listeners, the settlor is the person that sets it up, so that's usually the parents. Yeah.
But it gets more and more complicated. Certainly, if the creators of that trust are also American, it gets more complicated. You can have some real problems if you've got important charitable obligations. The charitable credits don't work well in that structure. If it's a straight up distribution among your kids on death and there's no particular need for ongoing trusts, it can be useful. As you alluded to, my typical reason for using that type of planning these days is because we strongly anticipate a challenge to the will. And so it's non-tax reasons, I feel, that really drive clients towards that sort of planning these days.
True. So that's what I see as well. And that people are increasingly rejecting the expense and administrative layer unless they've got a potential creditor. So maybe we'll say to the listeners, so British Columbia is a unique jurisdiction in that we used to have something called the Wills Variation Act, which has been encompassed into Section 60 of what's called the Wills, Estates and Succession Act. Do you want to tell our listeners what Section 60 is and what the implications are?
Sure. So this is the bane of the estate planner's existence. So typically from, what we learned in law school about testamentary wishes, testamentary freedom is a thing. Right. You can leave your assets to whoever you want. Now, British Columbia's legislature, in their wisdom, decided that it shouldn't be the case that you can just disinherit your spouse or child. It's not to say that you must give them something, but a judge always has the discretion to vary the distributions on petition by child or spouse of the deceased if they think it's just and proper. And so, you can see how that makes some sense, but it makes it very challenging when a client has actually good reasons for wanting to, prefer one beneficiary over another, and the case law is replete with really crazy fact patterns where wills have been varied, and you just scratch your head and I don't know. So it's very difficult to anticipate for a client like what the probability of success on one of these applications is. So if it's really important to prefer one beneficiary over the other and you want to make sure of it, a trust is not subject to the Wills Variation Act or now Section 60 of the WISA. So that is the most foolproof way.
So back to the U.S. planning piece, is there a bottom line for families considering trust planning when there's a U.S. element? And listening to you, I'm anticipating you're going to say it depends, but...
Well, no, the bottom line, I tell you what the bottom line is. The bottom line is to get some advice from someone who knows what they're talking about on these issues, because like I say, most of the time it's not a problem. But sometimes it really can be. And so being able to sort of, from the client's perspective, determine whether or not you have a problem, you can't do it on ChatGPT.
Are you seeing clients increasingly coming in with AI materials, or?
Oh yeah, absolutely. They do their research before they come in, and oftentimes there's some. It's not like everything in there is incorrect, but it's unreliable enough that you'd be foolhardy to leave it at that. And so I think that there is a level of education, sort of preliminarily, that the clients can accumulate using those tools, but the answer is always yes with those tools. And so, I think that if you're going to use those things as a way to set the stage or figure out what we want to talk about, don't close your minds to the things you don't know, because those tools do not, they don't have the context, and they don't know what questions to ask. And, it's really important to, seek out those advisors who have experience in this area and can, confidently tell you, do you have a problem or don't you? And that sets the stage for good planning.
So back to the minefields, can we circle back to the registered funds? Like what if we're assuming the parents are U.S. taxpayers, but maybe dual, what are the things they should know about registered funds like RRIFs and TFSAs and things like that?
Well, certainly on the RSP and RRIF side of things, there's not too much uncertainty left. Okay, so the U.S. certainly does not grant a deduction for your contributions. So it is possible for U.S. persons living in Canada to over-contribute to their RSP such that their Canadian income tax falls below the U.S. tax, right? And then you can end up paying some U.S. tax. So all the time, if you're a dual citizen, you should have a financial advisor who's aware of this. You should have accountants clearly who can do both sides, and any other team of advisors so you don't step in that one at least. Both countries will permit the deferral of investment income within that type of plan, and fully tax it on the way out. So that stuff is okay. All right, it's. The TFSA is the classic one that is, I still feel like there's some uncertainty. One thing that's not uncertain, the U.S. will tax investment income within your TFSA. So it is not tax-free on the U.S. side. Again, because of the high tax we pay in Canada, that doesn't always mean you're going to have dollars to pay to the IRS, but it's important to know it's not tax-free. In the best case scenario, it's just another portfolio account. And I think that there is some movement. I believe there's been some recent cases that came out that have sort of supported that position. I mean, it's been our position for a long time that that's the case. I think we're getting a bit of validation on that. Having said that, I have active IRS appeals where the IRS has imposed penalties as though this TFSA was a foreign grantor trust, is the technical term. And if you don't file the necessary information returns in the U.S., or more specifically, if you file them late, they're going to penalize first and ask questions later. So it is a bit fraught still with the TFSA. And I generally say, look, if we're getting started with planning, U.S. citizen says, should I have a TFSA or should I not have a TFSA? I feel like it's not worth the trouble.
That's what I understand as well.
That's my take on it. I think reasonable people can differ on that recommendation, but that's been my view.
So one of the themes of your book is that the IRS is watching. So maybe let's summarize so people know, like, what are the key filing and reporting obligations that U.S. citizens in Canada need to be aware of? Like, what should they be doing every year?
Well, certainly every year filing a 1040 tax return is the basic. And in that return, you report your worldwide income, regardless of its source. If you've paid Canadian tax, obviously that forms a credit. So you're taking it off the U.S. tax bill. So that's your basic. Your other basic is the FBARs, the foreign bank account reports. Most people have more than $10,000 across their Canadian bank accounts because it includes your RSPs and your TFSAs and everything. So most people are filing FBARs and 1040s every year. And, the penalties for not filing your tax return specifically have mostly to do a percentage of the tax you have to pay. So in times past, that has provided some comfort, I think, for people to say, look, I don't have to pay any U.S. tax. I don't have to file a return. Not true, because of all the information returns that are increasingly required under U.S. tax compliance. So, there's a whole suite of information returns that have $10,000 a year penalties for not filing it on time. And those penalties were designed with the absolute worst offenders in mind. And so then what you're left with is having to beg and plead for relief after they hit you with these monstrous penalties. And so that's a challenge. So, again, going back to the good advice thing, having a CPA that understands all of those information returns and the fact patterns that can give rise to having to file a 5471 or 5470, 3520. There's all of these information returns. It seems like every year there's more, and they're not obvious. You know, a layperson can't really determine whether or not they have to file. And so, you know, good advice is key. Those are the main ones. You know, and then everything else is sort of it just all flows from the facts. But, you know, if you're involved in Canadian trusts or Canadian corporations or, you know, have investment portfolios, we have to make sure that you have the right products in there and don't have things that give rise to U.S. tax problems. You know, you have to keep your eyes on the prize here and, you know, make sure that you're getting the right advice.
So I don't see this as much anymore, but earlier in my practice, I used to see a lot of what we would call like stealth Americans where, you know, they were born in Chicago in 1945. They've been here for 50 plus years and they've never filed. Like, you know, I understand there was a window of relief for the people like that didn't get the memo. Is there similar to Canada? Like in Canada, we have the voluntary disclosure program. Is there something left in the U.S. where somebody can come forward and file 40 years of returns? Or
so 40 years of returns you'll never have to do. Okay. So and there's a number of different streams that you can find yourself flowing down. Right. The best is called the streamlined foreign offshore compliance program. And you know, if you match the eligibility criteria for that program, it's basically 3 years of tax returns, 6 years of FBARs, and if there's any tax to pay, you pay it. Chances are there won't be, as I've said, and then you're deemed compliant. Okay, now you have to have some explanation for why you weren't filing, and that it was non-willful is the key term, which has a bit of an abstract legal definition that you know, we could get into if we had more time. If you are more of a okay, I've known about this the whole time and I've intentionally either underreported or failed to report, and I can't characterize this as non-willful, there are other compliance programs that come with penalties. And my view is those are best suited for people who, you know, really think that they might be going to jail, right? I mean, that's the major carrot they offer on this OVDP program. You're not going to jail.
Well, that's good.
But it's like 27% penalties or something. It's like crazy penalties. And so I've never actually had a client who fit that criteria. You know, the other thing to keep in mind too is, like, especially with the fact pattern that you threw out at the beginning of the question, you know, you've been here for 50 plus years, never filed, you didn't think you were American anymore. There's a narrow path to potentially argue that you're no longer American under those circumstances. And that's why, you know, it's important to assess that before you take some recommendation of going ahead and filing the last 3 years of returns, because you may not actually be American under U.S. law, right? And so it's important to evaluate that possibility before you sort of accept that you've been non-compliant your whole life, even though you didn't mean to, and sort of opting back into the system. So, you know, there's again, different strategies for different scenarios for sure.
So when is renunciation the right thing to do?
Well, I think that renunciation can be very valuable for especially that sort of accidental American who, you know, never really had any connection, certainly no desire to ever live there. And, you know, if they can get out, if they can get through the renunciation without any seriously adverse tax implications, it's a great thing to do. And in fact, just last week, they dropped that renunciation fee back down to the $450 level that it was at for a long time. the last few years, they had more than quadrupled it. We just heard that they dropped that fee down, which may actually encourage more people to follow that path. What you don't want to be is a covered expatriate, which is a tax term in the Internal Revenue Code that basically says, if you are a covered expatriate, you have all of these different tax consequences, none of which are good. And so my sort of planning strategy is, okay, we should consider expatriation or renunciation if we can avoid these tax consequences. I really don't want to have any of my clients be covered expatriates, because that's a label that you can't wash off. Once you're a covered expatriate, that's it.
So I understand migration planning is part of your practice. Do you see a lot of people moving to the U.S. with economic and tax factors? And if so, what's involved in that?
Yeah, I do a lot of migration work, both northbound and southbound. A lot of times, just the size of the economy gives rise to great opportunities for Canadian talent who wants to pursue, a job in high tech or banking or whatever it is. Those opportunities are there, and there are immigration pathways to get, highly skilled Canadians into that job market. And so it can be quite lucrative. I'll leave the immigration piece aside because you need a valid visa pathway. There's a number of different ones. The most important thing for southbound migrants to understand is that if you are going to terminate your Canadian residency, there's a capital gain tax event that we have to manage. And so it's a deemed sale of not quite all, but most of your assets. Certainly anything Canada can't tax after you've left are going to be taxed on the way out the door. And so we need to quantify that exposure. And the Income Tax Act does permit a deferral of the payment of departure tax if you post security acceptable to the minister. And so what does that look like? Do we have some asset we can post as security? Do we need to get a bank letter of credit? These sorts of things. But once you are out of Canada, you're no longer paying Canadian income tax on your worldwide income. I've had clients who moved to the U.S. because they viewed it as a tax shelter. They wanted to pay less tax. And so they were willing to trigger the exit tax and, move into a place like Florida or, Washington State that has no state income tax, and you pay a lot less tax.
What about snowbirds? So what are the rules with that? We have a place in Palm Springs. What's the maximum amount of time we're allowed to stay there before there's tax implications? Right.
So this is a classic one. And so most snowbirds will not become U.S. tax residents. And under the Internal Revenue Code, there's three sort of triggers for U.S. tax residency. Citizenship, clear. Green card status, clear. You're a U.S. person if you have either of those. The third is substantial presence in the United States. And this is there's a formula that we run. Takes into account the last 3 years of physical presence in the United States. It's time weighted so that the more recent years are more heavily weighted. The rule of thumb is under no circumstance go more than 182 days in the U.S. in any given year. And if you're averaging more than 120, there's a form you have to file with the IRS every year called the 8840, and that provides an exception to this substantial presence test. And so, 121 days, you're going to want to file on the third year of doing that. So depends on, how close to the edge you want to cut it. I have clients who for decades have been 175 days a year, Palm Springs, file your 8840, nothing left to do.
Okay. So if people are listening, what are the key things you want to leave them with? There's many, many families that are impacted by this. What are the key takeaways you want people to know?
Well, I think the key, really, it's going to sound like a broken record. The key takeaway is to get advice from someone who is competent in this area, because oftentimes the uncertainty is a source of stress that people sort of grudgingly live with because they haven't found someone who can unravel the tangled mess. So that's the most important thing. Don't make significant moves without getting that advice, because it's so much easier to plan out a series of transactions that avoids the really nasty consequences rather than trying to, clean it up after the fact. There's sometimes you just can't undo certain things. So, planning ahead, assembling the right team, and that, that would really be it. Anything else you can make it work.
How can people find you?
So I'm with Polaris Tax Counsel, polaristax.com, and my email is jonah@polaristax.com.
Great. Thank you so much. It's been great.
Yeah, thanks a lot.
Okay. This podcast is for informational purposes only and should not be considered individual legal, financial, or tax advice. Make sure to consult the advisor of your choice to advise you on your own circumstances. Thank you for joining us for this episode of Your Estate Matters. If you like this podcast, make sure to follow it on your podcast platform of choice. Whether you're planning your own estate or you're acting as executor for somebody else's, Heritage Trust can help. Partner with Heritage Trust to protect your family, your assets, and your legacy. If you'd like more information about Heritage Trust, please visit our website at heritagetrustcompany.ca. This podcast is produced by Podfather Creative.